The U.S. economy added 225,000 jobs in January, well above what economists had been predicting. Still, the markets are down 274 points because of the coronavirus. The Federal Reserve actually said that possible spillovers from the effects of the coronavirus in China have presented a new risk to the outlook. Certainly, the markets agree. Diane Swonk is a chief economist at Grant Thornton. She joins us live now from Chicago. Diane, thank you so much for being with us. So just walk us through your thoughts on the jobs numbers. Coming in stellar, a lot better than expected, 225,000 jobs added in January, and the warm weather helping, particularly in sectors like construction.
Exactly. We saw 44,000 job gains in construction, even though construction actually fell during the month before seasonal adjustment. That just means that construction jobs didn't fall as much as usual in the month of January, and it showed up as an increase. We also saw transportation jobs pick up and some local projects where people were fixing potholes and things like that pick up during the month. So once you strip those out, you get a little bit weaker jobs number, but still solid. And I think that's the important message here is even after stripping out the weather effects, this was still a good number. The 3.6% uptick in the unemployment rate was, of course, still accompanied by an increase in the participation rate, which is always welcome news, seeing more people throw their hat in the ring and willing to participate in what's become a marathon of an expansion.
I've been scratching my head over the market reaction because we've had several days, over weeks actually, in fact, of coronavirus fears, and we've seen the markets on record highs. And now today we get this really promising jobs numbers coming, and the market is down almost 300 points. What gives?
I think really the reality of the coronavirus is starting to set in. We started to see more reports of people saying that this is going to affect earnings out there. It was really kind of remarkable was how much the markets were slugging off or sort of, shrugging off the effects of the coronavirus, particularly on earnings. Not only are multinational firms being hit, but even, tourism is being hit. We've not seen that yet in the employment data. In fact, the employment data for January is all backward looking and prior to the coronavirus hits on the travel and tourism industry, which is being hit particularly hard. You had that whole great segment on what was happening in the cruise industry, but that's only one aspect of it. China is the second largest air traffic market in the world, so you can imagine the blow to that as well. So we're seeing travel, tourism, a lot of high-end. This is Fashion Week, coming in New York. We've got Fashion Week in Italy. All of those things are the Chinese wealthy tourists actually make up more than the wealthy Russians and Saudis combined in many of those spots. So it's putting a damper on luxury retail, but also across the board, you're seeing some ripple effects, layoffs now, announcements in some places like hotels and in the airline industry. And I think that's very important because we'll see some of that data as we move into February and March.
Okay, so let's take a look at these jobs numbers from a bird's eye view, because just explain to us why these jobs numbers over time have just been so resilient. You think about the fact that we've had 10 years straight of economic expansion. We already, and have been for quite some time, at full employment in this country, 3.6% as of today. But we continue to get these stellar numbers, over 200,000 jobs being added. Just explain that.
Well, we're not really at full employment. What it means is there's more slack and there's more room to run, is what the Fed has finally eaten its humble pie and agreed to. And if it was really full employment and labor markets were as tight as people thought they were, we would see much stronger wage gains. So wage gains have sort of stagnated at about 3% after hitting a high of close to 3.5% a little over a year ago. That's very important because what we're doing is we're finally, with this expansion, has not had in momentum. It's been subpar most of the time, 2%, 2.25%, something like that. It has made up for it in stamina, but that's not enough given how many people were hit hard early on. And there's still people standing on the sidelines that aren't participating. We're still below the participation rates, particularly for men, that we were in the 1990s boom.
So, as you mentioned, there's some slack in the labor market, clearly. So how will the Fed see these numbers then?
Well, certainly they'll feel good about the fact that they did 3 rate cuts last year instead of continuing to raise rates. The U-turn is justified because, in fact, what they were worried about, the inflation, isn't there. It's still that sort of high wire act for the Fed because, as you mentioned, the markets sort of really shrugged all this off. And part of the reasons the markets have shrugged off so much of what could be pretty negative impact on earnings from the coronavirus and some economic impacts as well is because of the liquidity the Fed has provided. So it's a high wire act for the Fed of trying to get a little shot of adrenaline to what's been a fairly slow and sluggish expansion and keep it going, sustain the expansion. That's sort of their goal now. But at the same time, when they're trying to do that, they're also worried that they're stoking asset price bubbles. And that's very hard because the Fed's tools are crude at the very best.
I want to look at what the coronavirus means to the global economy. Specifically, walk us through what you think it will mean in terms of hindering or impeding the rebound in global manufacturing.
Well, that's it's adding insult to injury. One of the things we're worried about out there is we're talking about a shutdown that's at least going to go into March, and good chances it could go even longer than that. And although most people are expecting a V-shaped recovery, the manufacturing sector was just showing some signs of life again in January. Not hiring, clearly we still lost jobs in the month of January, and the manufacturing sector actually slipped into recession in the U.S. last year and in many parts of the world. Luckily, that wasn't enough to take down the whole economy, but now you're going to set it back again because of the nature of the global supply chain. This is not 2003 when another coronavirus, the SARS virus, hit China, and China was just on its way up on becoming a manufacturing hub for the world. Now it's very integrated into every other economy out there, the second largest economy in the world, and when it gets sick, the rest of us feel the effects.